In this episode of the FXTM educational series, we're going to be taking a look at the Bollinger Band indicator, which is a price overlay. Now, the Bollinger Band indicator, which I've drawn here on the board, consists of basically two parts. The first one is a 20-period simple moving average. You can see it drawn here right through the middle of the price chart, especially right through the middle of that consolidation. Now next, the Bollinger Bands look at two standard deviations of the close price over those 20 periods. And what that means, those two standard deviations look at basically the close price over that period of time, where it's a calculation in which most of those, so 95% or so of those close prices should fit within those two standard deviations. Then those two standard deviations are added to and subtracted from that 20-period simple moving average. Now what that means is that we would expect that the Bollinger Bands will widen away from the moving average when the price is becoming more volatile, those close prices are becoming more volatile, and it should narrow when those prices are becoming less volatile and there's less deviation from one close to the next. Now, the Bollinger Bands can be used to identify specific trading opportunities as well. One of them that I'd like to start with is what I call a band tag. Now, this occurs when the price approaches either the upper or the lower band against the prevailing trend. So what I mean by that is that, let's say, for example, that the price were rising like it is here, and then it comes back and it touches that lower Bollinger Band. So it's counter to the trend that was in play at the time, and very briefly, so one period ideally, and then begins to bounce. It's a very strong signal that the price is likely to continue to the upside in the short term. In fact, let's take a look at a couple of examples of a bullish tag and a bearish tag. So here you can see a bullish example where the price in fact did come down and it touched very briefly that lower Bollinger Band before continuing to the upside. This bearish example is just a mirror image of what we looked at on the board and in the prior chart, in that the trend was already descending and then the price briefly touched that upper Bollinger Band before continuing to the downside. One of the other signals that we're looking for on the Bollinger Bands is a continuation signal that some traders will call walking the bands. And what we're looking for here is we're looking for a period of time when the price closes above the upper Bollinger Band, or in a downtrend closes below the lower Bollinger Band, and then begins to walk along one of those two bands. So in this case, you can see as an example, it closed slightly above that upper Bollinger Band and then began to walk along it. This is a very strong momentum signal that that bullish trend is likely to continue. In fact, let's look at a couple of examples of these on a couple of charts. Here's a bullish example of the price closing above the upper Bollinger Band and then beginning to walk along it. As I showed on the board, this is actually a pretty strong indication that the trend is likely to continue to the upside, at least in the short term. This bearish example is just a mirror image of what we looked at in the bullish example, in that the price closed below the lower Bollinger Band and then continued very closely to that lower band, indicating that there was strong momentum to the downside. Frequently, a period of time where the price is walking the bands, either the upper or the lower band, it's preceded by a period of time when the bands are squeezing very close together. In fact, we call it a squeeze. So you can see a couple of examples here where the price was trending relatively flat and the bands began to narrow considerably in both of these two examples. Now, generally what we're looking for is a period of time when the bands are closer together than they have been for quite a while. Let's say on a daily chart, maybe the bands are closer together than they have been over the last several months. Now, when the band begins to widen away from each other, and ideally, if the price were to close either above or below that lower Bollinger Band, we would consider that a squeeze breakout, and it's a strong momentum signal either to the upside or to the downside. In fact, let's look at an example of both of those scenarios on a couple of price charts. This is a follow-up to our bullish walking the bands example here, and you can see that that momentum signal had actually been preceded by a squeeze. This is actually quite common. This bearish example is also a follow-up to the example that we used to the downside of walking the bands, where you can see that momentum signal that was bearish was preceded by a narrowing of those bands compared to their normal width. Traders will oftentimes use the upper and lower bands as a way to target a potential take profit level and to set stop losses. So for example, if a trader were bullish and let's say they had just taken advantage of a bullish band tag, they may target for a take profit the upper Bollinger Band. So you can see here, if an investor had traded long at that point, they may be targeting where that upper band was at the time as their initial take profit or a good estimate of where they expect the price to get in the short term. Now, by the same token, of course, if an investor is watching the Bollinger Bands and let's say they take a trade to the upside, they may actually monitor that lower band as a point at which to set stop losses, assuming that if the price gathers enough momentum to cross below that lower Bollinger Band, or for a short, for the price to get above the upper Bollinger Band, that momentum is now beginning to work against them, and therefore they should set a stop loss level above or below that Bollinger Band, depending on which direction they're trading the market. Bollinger Bands can tell us a lot more than just whether or not the price is becoming more or less volatile. They can also help us to identify trading opportunities, especially within the prevailing trend.